right, Stephen. Opposite situation of what we had with Austin earlier in the presentation, the first 20 minutes of our presentation. Stephen is long 2 MS May 85 calls. Getting close to expiration here. Okay, I'm going to assume May 21st. That's fine. It doesn't matter. 85 calls, 2 at a price of 170. Date doesn't matter there. Okay. And it closed today at 78.59. All right. Are there any repairs? What can I do to repair the position? Okay. Well, I don't think the position analysis is going to show me any rollout opportunities. You might have already seen those. That's what I figured. Okay. So let's take a look at the profit and loss chart, or the what if calculations, so we can do some things potentially on the fly. First thing I want to know, Stephen, is what is coming up for MS. I don't know this particular. Okay, I know the stock, but they're probably one of the ones just like some of mine. Oh, they had earnings today before the market. Earnings just came out, just like my Ally position, the new Marriott put. I opened, it gapped up 3% in the first 2 hours. It was up 3.4% in the first 2 hours, and then it ended down about 11 cents on the day. Okay. All right, so earnings are non-factor. What do I mean by a non-factor? Well, if I had earnings coming up in the next 2 or 3 weeks, I may consider rolling these options down, even though it would be at a debit and I'd be adding cost, or maybe selling both here, buying one lower strike call and one lower strike put to have a strangler straddle going into earnings. But that's now a non-factor. As we talked about with Austin a little bit, after we reviewed the 8 ways he could consider maybe managing that long call, there's probably 20 ways he could consider. We just wanted to show the 8. We got a little complicated, but that's always fun to do. So, Stephen, what you have to ask yourself is, what is your expectations going forward? Any of those adjustments we discussed earlier for the winning trade, we would choose the one based on what our expectations feel for us. Okay. If you feel that Wells Fargo is going to settle and you're still bullish on the market long term and you think it's going to start moving up in price, then number one, what I would consider doing is selling to close these 2 and buying to open something further out in time, going to July, maybe going to September. Why? Because whatever you have left in time value, that 48 cents we saw here, is going to start decaying more rapidly. And as I mentioned in Austin's view with his June calls on Wells Fargo, there's only 63 days left. So we're getting it to the bottom end of that time decay curve. So that's going to start decaying against you rather rapidly. If you think the stock's going to recover, you think this is still a good trade for a bullish strategy, Stephen, you may want to consider going further out in time to avoid more rapid time decay in the short term. Reposition yourself for further upside. Roll them down to a lower strike. Maybe sell these 2. You're going to pocket a loss, but then maybe only buy one contract further out so you don't have too high of an exposure. Is now the time to try to prevent this with a calendar? Excuse me, try to head this as a calendar. Well, it's close. Even though you have weeklies, you're only 35 days away, the standard expiration. Let's look at April 30th. It's 14 days away. Some decent premium here. You're at the 85. Oh, that's because I'm in April, not in May. Yeah, I think I saw you had the 48 cents or so of time value left on these options. I could sell an 82 call. Why am I selling something so low? Well, I'm still trying to get some premium on the position. In this case, don't like it. Yeah, that's what I was afraid of. So this hedges your cost into the position. You're going to get about 83 cents against it. Your original cost base was 340. You're going to hedge that down by 83 cents. And so you have a new risk of 243, but you can't make any profit on this trade. This would be a continued management to hope that these calls expire worthless, and then you could maybe sell the 14th or 7th of May calls for another 20 or 30 cents, but it's not helping you repair it in that case. If the bearish sell warnings continue, you might be able to do that. There's no way you could do a bear call right now that would make any sense on this position, I don't think, because you need to collect more premium. This is highly dangerous. I don't recommend doing this. But if you expected further downturn, and you created a bear call spread selling the 2 May 77.50 calls, 286 apiece, you now have a bear call credit spread on this position. But this is extraordinarily risky. You can see it. This is why I probably wouldn't do it. This is in the money now. You've got 2 short calls that are in the money and your protection's up here. If you get assigned early on this, you're going to be short 200 shares of MS at 77.50. And what's the other problem? You're down a couple $100 right now. This has the potential to lose $1,200 if the stock swings back up above 85 on May expiration. But I would never sell the in the money, but if you have, it's so hard. If you have a bearish outlook, if the 2 sell warnings come in play, we think there's going to be a pullback. In that case, it's so close. There's a potential with the just out of the money 80, but this is why that expectation is so important. The conditions and the expectation. Oh, really? Well, there you go. It was a 2-cent hedge, Stephen, in that case. Okay. So nothing short term if you're really bearish on the position. There's no if MS falls on Monday and falls down to $78, you might be able to sell this. No, you're going to get less premium. Yeah, I'm sorry. I'm thinking of puts, Stephen. I'm sorry. My apologies. It's not going to increase in value. If it falls, those 80s are going to be worth maybe the 77.50s. If the stock falls to 77, those would look good. But you got to be aware of that margin requirement because you're now in a bear call credit spread and it could come back to haunt you. If you're more bullish on this position, you might just want to close these calls now. Take the loss and buy some out of the money puts 40, 50, 60 days out in time if you're expecting a downturn. Or if the market starts to fall and you think MS is going to continue down, you might have an opportunity to convert this to a bear call spread for May expiration. The 77.50 strike, or even if it starts to move back up slightly, you might be able to get more than $1.70 for the 80 calls. It could put you in some profit if your expectation is it'll stay below 80. If you think MS will recover over time, just close these out right now, pocket the loss, reposition yourself at a lower strike, as I mentioned, for maybe June. I'd probably go to July, at least 90 days out is what I usually prefer, 75 to 150 days out. And of course, we'd be looking at potentially maybe something like the 85. Wow, 85 calls almost at the same cost as your original one. But you may be able to reposition at the 80. I know you don't want to spend too much money, or the 85, if and only if you think it's going to recover long term. Is the stock repair that we showed for Lance, in the case of the SI put that was put to you, a good idea with these calls? It's tough because that ends up creating a butterfly almost, but a butterfly on an already losing position, not a butterfly in a winning position that we saw before, which is much tougher to do. Let's think about it this way. If you were forced to buy shares of stock at 85, if you allowed yourself to exercise these calls, I should say, if the stock was above 85, you'd have a cost basis of $86.70. Okay, so at May expiration, Morgan Stanley's at $88 in that case. You don't close it, you take assignment. What's your cost basis? You've got 200 shares at $86.70. So you could consider, all right, well, let me check the stock repair tool. And since that would be my cost basis, if I did end up exercising my long calls, what if I did buy 200 shares of stock of MS at $86.70? At some point, are there any viable repairs all the way out to September? I think that's too long to be sitting in a repair. And by the way, it doesn't work the same because you need it for May. Okay, you need that repair for May, not September. Your broker's not going to like this because you're selling 4 calls at 77.5 for September expiration, and you're buying 2 calls at 77.5 because we put in 200 shares. You'd be selling 4 at 82.5. Now you have protection to May, but after May expiration, that's gone. You end up with 2 naked calls at the 82.5 strike with Morgan Stanley bouncing around 72.59. This is not a viable repair against a long call in this case because the expiration is too far out in time. If you're bullish again, considerations there of going into the position, closing yours and moving out to maybe a different strike out to July, out to September, depending on what your estimation of the stock is going forward. Trying to force a fix here for May with a butterfly scenario that we saw before. What if I sell 2 at the monies and buy it deeper in the money? Okay, does that work? Probably not. All right, so we're going to sell 4 here. We're going to buy 2 here. Okay, that gives you a potential. That's not bad. Your upper break evens at 77.81 and 82.19. But what do you have to do? Put up $1,000 for the portion of this, which is now a bear call credit spread. Okay, max loss on the position is 561, about 50% higher than what you have. Well, it's more than that, isn't it? Yeah, it's $220. So it's about 2/3, 60% higher than the maximum risk you have right now. That happens at 85. And it happens at 75. Again, takes a margin requirement. You have to put up the $1,000 to do this. You got a debit there of 561 in this case. But if you think Morgan Stanley is going to stay between 77.81 and 82.19 in the next 63 days, the butterflies / condors, this is a call butterfly. Call butterfly repair can be useful. But again, if I see that second bearish warning come up on Monday or Tuesday, I know that sometime soon there's going to be a slight correction where this could pull down. Now you're starting to get more and more into that loss area on this position, and the risk is 60% higher than the maximum risk. You don't even have the maximum risk on this long call right now. These peak profit and loss things with these Death Valley areas in here, and of course the tight break even. It's not too tight, I guess, for Morgan Stanley. It's 5 points, Stephen, but it is an option. It does give you a good potential max return when, if and only if, MS is trading right at $80 in the next 35 days on May expiration. Okay, so depending on your outlook, we showed some ideas. You convert it to a bearish position. You're still more bullish and think it's going to recover. You could roll down the strikes, take the loss here, move down into a further out position, and as we talked about earlier, now that you have that further out position that's out to July or September, you could consider converting that to calendar spread to start collecting premium against it to hedge it. Okay, because it is going to be a much higher cost. Evaluate the potential repairs, evaluate what your expectations are, and evaluate the repairs based on what is the monetary risk in the next 20 to 30 days, and is it worth it to increase the risk in this position for a chance to repair if and only if the stock's trading between this range and that max profit that looks enticing, taking from a loss that we're at right now on this position to seeing a potential profit of 28% against the margin requirement we'd have to put up for the trade. That looks great, but it only happens if MS is right at right at $80, Stephen, on May expiration. But those are some ideas that we have there, okay? So consider that, think about that. Think about some of those ideas there based on what your expectations are in that case going forward for the repair on the losing long call. Just as I mentioned a moment ago for Lance, other places you might want to check out here, the free webinar section under option strategies. Let's see here. Let me scroll down this way. Here we go. I'm sorry about that, folks. There we go. Where is it? There's managing a bought put that is going against you. Okay, so that's a long put, but there's some ideas in there, Stephen, that might help you with the long call. I thought there was one I had recently, was managing a long call that was going against you. Either I just missed it. Apologize for that. We're going to look it up in just a second. It's not under options concepts. I doubt it's in requested topics. Comparing stocks, fundamental criteria, tips. No. Okay, what's on Power Options Tools top 5? Okay, so let's go to YouTube and let's search. I'm going to usually call them and title them the same thing, Stephen. So we're going to call it managing. I think I should call it a long call. 8 months ago, 2 years ago. Here's the full webinars, managing your long options positions. Let me just see long call here. Let's just do a search for long call, okay? Buying out of the money calls. When is parity not a parity? Maybe I should try bought call. There's call spreads versus long calls. Okay, let me try a bought call. Rolling collars. No. Okay, I apologize. Covered call, rolling the money. Okay, but there are some videos here. I'll try to hunt it down for you. I thought I had one that was managing a long call that goes against you, similar to the recent one we did with managing a long put that had moved against you, Stephen. I'll try to hunt that down for you. I thought it was in the last month or two, but pairing naked puts, high liquidity. These are in order from 1 month ago. Yeah, I'm not seeing what I thought was there. Okay. All right. But I'll definitely try to find that one for you. Recent one we had on similar situation on managing a long call that had moved against you in that case. But you can see some of the webinars here. Again, option strategies. There's that full webinar there that's managing your long options, which goes through different ideas, Stephen. Also, you can check out YouTube as well for that. As we mentioned for Lance, with the potential for managing your broken position as a covered call that's down in price, naked put that gets assigned to you for a loss, or other scenarios as well. Check those out in the webinars view or search directly for it, of course, on our YouTube channel. Okay, well, ladies and gentlemen, I don't see any other questions that have come in. I think we got all of them in there. If you do have any last-minute questions, you can go ahead and send those in as well. Just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Most of the positions that we looked in were management. We saw some of the spreads that came up on Don's search for the criteria that we put in that he wanted for high liquidity, 30 delta or less. That was not a direct recommendation to do a bull put on Facebook or anything of those natures. You'd still want to use the tools and power options to further research and analyze any positions you saw in today's searches to see if they're right for you. As we've seen with some of our discussions today, for Lance's question about the SI weekly naked put of the day that dropped in price, and Stephen's questions on the MS calls, options do involve risk and may not be suitable for all investors. However, we will keep doing our best to train, educate, and discuss how to manage losing positions, trigger points for exiting different option strategies before they go too far against you, and more as always. We looked at the search tool today. We looked at the portfolio a little bit earlier. We saw how easy it was to create a search. We looked at the stock repair tool, see how easy it was to maybe get a repair on a position. Well, if you like some of the tools that you saw today, remember you can take a 14-day free trial to Power Options at any time. Just go to powerop.com and all you have to do is put in your name and email address. You'll have full access to all the tools we showed today and many more for 14 days. You can access all of the searches. You can use the defaults or create your own search for your needs, as we showed for Don earlier as well. You have access to those signature tools, not only the stock repair tool, of course, the market sentiment tool that we're going to be keeping an eye on going into next week as well. We saw that bearish sell strong warning come in today, and if it comes again on Monday, then we will definitely be considering adjusting our positions, as we talked about for CoCon there as well. The stock insurance tools in the signature tool also, and you have access to the backtest tools as well, and the portfolio tools we saw for evaluating rollouts and more. No credit card is required, just name and email address. After that, the monthly subscriptions start at just $45 per month for the end of day data service. Of course, we also offer a 15-minute delayed, 10 to 15-minute delayed service as well, which is $65 per month, a real-time and full access to the historical tools and different upgrades. You can cancel at any time. There's no contractual requirement. Free coaching is available on trial members, and for subscribers, you can upgrade at any time as well. We talked about the free education available. Hey, at any time, you can just go to powerop.com/webinars.asp. and scroll through the different webinars we have on the Power Options tools, option strategies, concepts, and requested topics, or go to the YouTube channel there as well, and you can just scroll through the videos in order, or do the basic search that I tried to do for Stephen, but couldn't find that one on managing a bot call that goes against you. I thought it was in there recently in the last month or so, couldn't find it, but I'll do my best to locate that for you. Also, you can check out the blog or the Learning Center on powerup.com for other articles and resources as well. Well, if you think of any other questions over the weekend, as always, remember you can send me an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And as I mentioned, trial members and subscribers, remember you can schedule the free coaching session at any time.